China is a big buyer in silver as well. There's empirical evidence to that showing that in silver this morning in Shanghai, the market opened up limit up and opened up at $35.38 an ounce. But on the Shanghai Futures Exchange, it opened up 8% limit up on Monday morning. And so when you talk about the drivers that typically would spell reversal in the price of gold, a strong dollar, strong interest rates, in this case, and an inflationary agenda that seems to be running out of control, which would speak to higher rates for longer, it doesn't matter. I think that's really what's different this time is that the pursuit of non-dollar denominated liquidity is outpacing the demand for dollars in U.S. Treasuries.
Gold prices, aided by China's stimulus measures, looked poised to clock their second consecutive weekly gain on Friday on renewed hopes for U.S. interest rate cuts. Silver broke the $30 barrier to hit an 11-year high. Spot silver jumped 4.8% to $31.02 per ounce after breaking above a major resistance level of $30. While silver briefly hit this level in early 2021, sustaining it for an extended period has been elusive for over a decade. The renowned president and owner of Miles Franklin, AndySchectman, notes that the arbitrage in silver is particularly pronounced, with a substantial price spread between Western and Eastern markets. While the spread is smaller in gold, it is still notable. From a technical perspective, Schectman states that the usual economic drivers for gold and silver prices must be held up due to the strong demand for non-dollar-denominated liquidity, especially from countries like India and China. He views this shift as a fundamental change in market dynamics, such as Gibson's paradox, which is becoming less relevant in the current environment. Beijing is also diving harder into purchasing gold to diversify from the dollar. Now, the metal makes up 4.9% of Chinese reserves, the highest since at least 2015, Bloomberg said. It's a trend followed by other central banks, who have also been snapping up bullion at record speeds. However, Schectman predicts that exchanges in Dubai, Shanghai, and Moscow may soon trade silver at $50 an ounce and gold at $3,000 an ounce, attracting traders and potentially depleting Western supplies. The two metals move largely in tandem as both offer similar macro and currency hedging properties. With gold hitting a record on central bank buying, retail interest in China, and a resurgence in bets that lower U.S. interest rates are on the way, silver's gone along for the ride. Regarding the growing competition for precious metals between industrial users and investors, Schectman highlights that countries like China are scrambling for metals. He notes that this intense demand is creating lucrative arbitrage opportunities. Now we present the clips of AndySchectman's insights from his recent interview with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Adding $1 trillion in debt every 100 days. Inflation is the symptom, not the driver. That's the bottom line. And our spending habits aren't going to change anytime soon. And so deficits will get bigger, interest rates will rise further. And, the term in economics, Gibson's paradox, which traditionally speaks to the inverse relationship between real interest rates and the price of gold in particular, in this case, seems to not be as relevant in an environment where gold and silver prices are not aligned with their usual drivers, in particular the 10-year Treasury yield and strong dollar. Because as Vince will often say, they just want the metal. And I think India just wants the silver. China just wants the gold. Of course, I'm generalizing there. I think China is a big buyer in silver as well. But, you can, and let's say there's empirical evidence to that showing that in silver this morning in Shanghai, the market opened up limit up and opened up at $35.38 an ounce, but on the Shanghai Futures Exchange, it opened up 8% limit up on Monday morning. And so when you talk about the drivers that typically would spell a reversal in the price of gold, a strong dollar, strong interest rates, in this case, and an inflationary agenda that seems to be running out of control, which would speak to higher rates for longer, it doesn't matter. I think that's really what's different this time is that the pursuit of non-dollar denominated liquidity is outpacing the demand for dollars in U.S. Treasuries. I think that's exactly what you're seeing. You're seeing the industrials freak out. and they realize, man, it's getting hard to get, and they're trying to get all they can. And the Chinese are doing the exact same thing. There's this battle, if you will, between the industrials and the investors, or the industrials and the accumulators. And I think ultimately that's what will happen. There will be a battle between the companies who need it to survive and the countries or the investors or the sovereign wealth funds or the central banks who think they need it to prosper and advance. And I think that battle is happening right now in front of us. It just, no one's really talking about it. But that to me is exactly what's happening. And that's why you see arbitrage going higher, because they figure, well, if we can't bleed the exchanges, if there's too much competition, let's just crank up the heat, and all the traders who can buy in the West and deliver in the East will do just that. So I don't expect that to change. In fact, I wouldn't be surprised if ultimately we wake up one day and see, the exchanges in Dubai, in Shanghai, and in Moscow buying silver at $50 an ounce and buying gold at 3,000 an ounce. And just like that, everyone who's stupid enough to pry free what is available to be pried free will do so, will arbitrage it, and never coming back. I've been saying this for a long time. The difference is the people in the West here have a very short time frame. The instant gratification is not fast enough, and the Chinese, for whatever their shortcomings, they are very strategic, and they do things in a very methodical, regimented fashion. And that's, to me, what this is. And it's a trend that has not gone lower, but is only going higher. And interestingly enough, mostly in silver. The arbitrage with gold isn't that great. What did he say gold was at today, our friend, the ghost? He says it's at 24.68. Well, what do we got spot at right now? 24.30. So they got a $40 spread right now in gold, but a $4 spread in silver on a percentage basis is massive. So yeah, I think this is something we will continue to see happening. It's their way of accumulating whatever they can possibly get, but not fast enough to wake everyone up. What? The Chinese are paying what for silver? But just enough so that...
During the interview, AndySchectman mentioned the ongoing shift away from the U.S. dollar by non-Western countries trading in local currencies and accumulating gold and oil reserves. He foresees hyperstagflation characterized by higher prices, increased taxes, and minimal economic growth. By some measures, the greenback has lost some of its dominance. Global central banks' dollar holdings fell some 20% from 2002 to 2022, while U.S. sanctions on Russia have prompted China and others to reduce their reliance on the dollar in trade. Despite the general public's lack of awareness about these significant shifts, Schectman emphasizes that the impact of rising silver and gold prices and the trend of de-dollarization will eventually become apparent. Let's get back to the interview.
Exact same thing, just differently not in the same words, but the same ideology for 2 years now. That's what happens. The little by little, the logarithmic decay, the chipping away at the hegemony of the dollar, all of these countries that are not Western friendly in the Southern Hemisphere, chipping away at the settlement status of the dollar, trading in local currencies, replacing those local currencies with gold and oil in terms of excess reserves that normally would wind up in treasuries. That little by little by little by little, the debasement of the settlement and the reserve status of the dollar is growing much more profoundly. And I think this is a situation where, when you talk about rising prices, look, if you spend $100 every second of every day, 24/7, it would take 1,970 years to print just as many dollars as we've spent in 1 year, over $6 trillion, or created in 1 year. The level of inflation that was created by money creation, the classic definition of it, is exactly what we should be expecting. And that hasn't even flushed its way through the system yet. The debasement, or the falling dollar, is a reflection of the weaponizing of the dollar, is a reflection of the fact that these countries no longer trust us. It's like a glass broken into a million pieces. When you break it, you can't put it back together, at least not very easily. And so what you are seeing is a byproduct of the same time of the ramifications of massive money creation, most of it done over the years where interest rates were near zero, creating huge distortions in asset prices. The end of it is rates were still rising. Well, they were still creating tons and tons and tons of money, which is going to fuel the inflation. And as rates rise, maybe that we head towards that stagflation. But the point of it is that I think there's a disconnection now, whereas in years past, everyone wanted dollars, everyone wanted treasuries, everyone wanted to be part of the American system, and that system no longer, I think, is inspiring as many participants as it once were. So yes, I see this exact same way that Rafi does, maybe hyper stagflation, higher prices, higher taxes. What did the knucklehead say? If he wins again, he wants to raise capital gains to 44.5%. He wants to raise income taxes. He wants to impose a mandatory tax on unrealized gains for the very wealthy, higher taxes, higher inflation, little or no economic growth. And I do see a time where the world finally, that all at once moment triggers, and there is a dumping of dollars, there is a dumping of treasuries that accelerates, not just what we've seen slowly and methodically and orderly, where China has gone down to 750 billion from over 2 trillion, almost 3 trillion. That's the little by little by little. The all at once hasn't happened yet. But what I do think, when the all at once happens, it will shock people. Like to Rafi's point, no one knows that silver is over 30 unless you're in our camp. And it's a very big deal for the people in our camp. Most people wouldn't know a silver dollar if it fell on their foot, or the ramifications of rising silver, what it really means, or massively rising gold and de-dollarization. All of this stuff we focus on, the public is asleep. And so I see the exact same thing. Higher prices, higher yields for longer, and continued de-dollarization and de-treasurization that we continue to foster. Where Janet Yellen has the nerve to tell China, if you give 1 penny to Russia to aid their war machine, we're gonna sanction your banks, your companies in Beijing itself. Don't worry that we've given 200 billion to the Ukraine with no congressional oversight. That's our business, and we're the world reserve currency. This is not settling well with the Southern Hemisphere. So yeah, I think that's exactly what will happen now. To your point, what does it look like? Who knows? I mean, yeah, I think it won't last forever, but there could very well be a time where things of value are used to barter, because who's going to want dollars in an environment where no one wants to hold them for any significant amount of time whatsoever?
According to CNBC reports, silver prices could soar to their highest level in a decade. Many analysts have attributed 2024 gains in precious metals to expectations for interest rate cuts by the Federal Reserve later this year. How do you view China's increasing focus on precious metals and its efforts to reduce reliance on the US dollar in trade? And how might these actions influence the future of the global financial system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.